Hi friends, bookkeeping and accountancy is an essential part of our living and for the economy, and in modern day we all need to know the aspects of accounting. I have modulated in this video to make it even simpler for HSC students to understand the basic concepts, and so I take it from the elementary level to advanced level in simple terms. In this part, let us examine the basic concepts. Bookkeeping is the practice of recording financial transactions in the books of account meant for this purpose. Accounting is the systematic process of preparing, presenting, and communicating financial information to the stakeholders of business such as promoters, shareholders, investors, creditors, labor, and the government, who all depend on this valuable information. The information technology sector also need to know the principles of accounting as they write computer programs for finalization of accounts and for its various interpretation on various aspects as useful information to the management. The promoter is a person who initially started the business. All business enterprises, be it a sole proprietor, partnership firm, partners in the firms, private or public or listed companies and public sector companies, banks who have lent monies to the corporates, and also persons controlling the business would like to know at any particular period the funds available in the business, how the funds have been used in the business during any financial period, and the results achieved by the organization in any financial period, mainly to know whether it would be gainful to continue the business operations or how to restructure the existing business operations after taking suitable corrective measures to make it gainful. The main concepts of accounting are business entity concept. This concept means the business is viewed as distinct from the person who owns it. Money measurement concept. It records only financial or monetary transactions. Besides, quantity also is mentioned in inventory accounts for controlling purposes. Cost concept. It records only the actual cost incurred in every business transaction. Going concern concept. It is assumed that the business will continue for a long term. Dual aspect. Every transaction has got two aspects, one debit entry and corresponding credit entry. If asset comes in, the money has been spent on it. The formula is assets must be equal to liabilities. Mathematically, assets is equal to capital plus liabilities. The trial balance is a list of all accounts on the finalization of accounts on a particular date in which the total of debit balance accounts must tally with the credit balance accounts. Realization concept. It records only transactions that have taken place in any particular financial period. Accrual concept. This arises mainly due to the finalization of accounts on a particular date and to ascertain the actual amount that would have been realized or payable. For example, if the business has made some term deposits with the bank, the interest that would have been received on the closure of the accounting period on such term deposits, though its maturity date has not arrived, we must quantify that amount and take it in the accounts. Accounting is a business language of passing entries in the books of account. For each business transaction, there are two entries, debit entry in one account and corresponding credit entry in another account. This is the dual concept of accounting. If the debit entries are more than the credit entries in any business account, we say that it has a debit balance on any particular date. Similarly, if the credit entries are more than the debit entries in any business account, we say that it has a credit balance on a particular date when it is balanced. The trial balance is only a list of all credit and debit balances in all accounts on any particular date, and the credit balances and debit balances in the trial balance must tally. If it does not tally, it shows errors in the passing of entries. There are three types of accounts basically in business transactions. 1, property accounts. 2, personal accounts. 3, nominal accounts. The rule of debit and credit is explained here. Listen carefully. Property accounts debit what comes in, credit what goes out. Property accounts are machinery and cash. and bank balances. Suppose you buy machinery in cash, you debit machinery account, credit cash account. Suppose you buy machinery by issue of a check, the banks pay money. So, debit machinery account and credit your bank account. Personal accounts, debit the receiver and credit the giver. Personal accounts are in the names of individuals and or other business entities who have business relationship with our organization. All other accounts are nominal accounts and the rule is debit all expenses and losses and credit incomes and gains. Property accounts are land and buildings, plant and machinery and tools, furniture and fixtures, vehicles, investments made, inventories on hand, cash and bank balances. Nominal accounts are accounts other than property and personal accounts, such as salaries and wages paid, bank interest and financial charges paid, depreciation, namely the monetary value of wear and tear of the assets for any particular period. Here, the rule is debit expenses and losses, credit incomes and gains. Nominal accounts, the rule is debit expenses and losses and credit incomes and gains. Let us take it to the next level in the next part. Thank you.